Hi, good evening to everyone. Avinash, can we move to the next slide? If we look at global economy, thanks to Russia-Ukraine situation, commodity prices have reached all-time high and it has crossed previous peaks as well. Next slide, please. Now, typically in such kind of scenario, central bankers have to raise interest rates. And we have seen, starting from US Fed, which was way behind other central bankers, interest rates have started moving across many markets. Next slide, please. Courtesy that what we are seeing is that bond prices have dropped across the world, and we have seen one of the sharpest correction in bond index. In the past, there were many indices, many bonds which were actually having negative coupon rates. Today, all those things have reduced to a significant extent. From about 18 trillion issuances of negative coupon-bearing bonds, now it has come down to almost $3 trillion. When interest rate rise, inflation rise, supply gets restricted, no doubt that GDP starts slowing down. Today, we are seeing sharp slowdown in GDP of current year 2022 over 2021 across most parts of the world. Someone like China will end up witnessing almost 50% drop in GDP. Someone like India will witness marginal drop in GDP. The US yield curve, which is difference between 30-year and 5-year government security, has turned negative. Normally, when longer bonds start yielding lower return than medium bonds, it is harbinger of recession. It is harbinger of slowdown. In the past, this kind of inversion has happened in 2005, and that was indicator of recession coming in 2008. Today, bond markets has casted their shadow on equity market. Rising oil prices, rising inflation, and rising bond yields are worrying global equity investors. No wonder that equity markets in developed world as well as emerging markets have corrected. Someone like Russia has corrected big time, 36%. But across the world, most equity markets are lower today than they were at the beginning of this year. In S&P 500, company giving guidance about slowdown in earning is increasing. It is now almost at the same level as it was in fourth quarter 2019. This is maximum witnessed in technology sector. In Nasdaq Composite Index, stocks which are down 75% from the top is roughly about 20% of the index constituents. Stocks which are down more than 50% is about 40% of the index constituents. And stocks which are down more than 25% is roughly about 60% of index constituents. Like our microcap index, Nasdaq also has suffered large correction. To compound problems in technology sector, Chinese internet companies have also seen massive correction. Stocks like Tencent, Alibaba, they also have corrected by more than half. Alibaba now trades at the P ratio of about 12 to 13, which will qualify them as a value stock. Collectively, Chinese internet companies' market cap has dropped by about 70%. What will fund managers do in such scenario? Across the board, we are seeing that cash level across fund managers has started increasing from about 4%. It is touching about 6%. This is one of the highest, except in the early TMT bubble crash. Now, the real question is, what will be the shadow of rising inflation having on the global economy? If we look at crude, metal, and food grain, they constituted combined 8.1% of world GDP in 2019. Now prices have shot. In 2022, we expect them to contribute 12% of global GDP. Between 2019 to 2022, global GDP will increase by $7.5 trillion. 55% of that will be consumed by crude, metal, and food. Such kind of rise will have impact on demand. We believe there will be demand destruction thanks to rising crude, metal, and food prices, and that will be negative for global GDP. Look at commodities and metal prices is comparing them on a historical basis. Today, metals are almost at their all-time high level. Other prices of food, metal, energy are also nearing their all-time high level. We believe as demand destruction starts, over a period of time, there will be drop in commodity prices, there will be fall in inflation. Whether it is 3 months away, 6 months away, a lot depends upon how quickly supply side solution emerges. The other burning question is that today Russian central bank realized that their dollar reserves have been frozen. They are not able to access more than $450 billion worth of foreign exchange reserves in foreign currencies. Effectively, other than gold, they are not able to access any foreign currency reserve thanks to the sanctions. Will this result into reduced dominance of US dollar? Will central banks go towards other currencies like euro, yen, renminbi, or they'll go to gold, or they will go and held rupee? Who knows? Whether dollar is giving its position as reserve currency of the world, that's the question which will continue to hound market in America in the days to come. Coming to Indian economy, well, all the headlines in the month of March and April beginning was very positive. GST collection for the month of February reported in the month of March is 1,42,000 crore. People expect March numbers to be reported in April to exceed this. Exports for the first time crossed $400 billion in goods exports. Automobile exports, despite all the challenges, are likely to be all-time high. Housing sales in first quarter, Jan to March 22, were all-time high since 2015. While manufacturing activity did moderate in the month of March, the outlook towards the future has become little bit weaker. There is a transition in economy as well as market between, say, period April 20 to October 21 versus now. Earlier, central banks were easing. Now, central banks are raising rates. Earlier, corporate earning was almost doubling. Now, corporate earnings have started slowing down. FPIs were buying Indian equity and emerging equity like crazy. Now, they are selling like crazy. The one matter of comfort for India compared to 2013-14, when oil prices were at $100 a barrel, we are in a better position today to manage higher oil prices. Our foreign exchange reserves are higher. Our current account deficit is manageable. Our external debt continues to remain low, especially at the short term. And our import cover has grown over the years. Our economy today is benefiting from lack of COVID-19. In China today, there is lockdown coming in one city after another. In India, we are all celebrating Festival of Color without worrying about COVID. Let's pray this continues going forward, as open access is very, very critical for economic growth. The business resumption index is at all-time high. It has steadily grown after the Omicron impact in January 22. And today, we believe economic activities have picked up the pace and it is firmly above pre-pandemic level. The high-frequency indicators such as exports, power demand, GST collections, railway freight, passenger vehicles are all turning to be positive. Two-wheeler sales continue to remain on the softer side, but hopefully that also should pick up as we expect a normal monsoon in the coming season. The agriculture GDP growth, which remained positive during pandemic, continues to remain supportive, and with good monsoon, normal monsoon expected this season, agriculture growth should sustain. As I mentioned earlier, the prediction of 2022 monsoon is expected to be normal at historical average of about 880 mm. The investment pipeline has slowly and steadily started building. Private sector is putting money, government is also putting money, and we believe recovery in investments along with agriculture eventually will push consumption higher. The production-linked incentive scheme and government's focus on infrastructure spend is resulting into higher investment. Today we are seeing roads, power, railway, urban infrastructure, and other infrastructure picking up the pace. It is supported by investments by private sector. Put together, we could see our investments growth moving from about 8% to somewhere around 14 to 16%. We will have almost 1.6x increase in investments between central, state, and private sector. Production-linked incentive schemes, we have spoken multiple times in our presentations. We believe PLI is supporting investment across various sectors like automobile, specialty steel, solar PV, pharma, electrical batteries, textiles, and so on and so forth. Obviously, our concern continues to remain with crude prices. Our Rahu column starts whenever crude prices jumps through the roof. A 10% increase in crude increases inflation by 40 basis points. It hurts our current account by 30 basis points and reduces our GDP by 20 basis points. Being one of the largest oil importer, oil has adverse impact on India's economic numbers. This year, rising crude prices can push current account into deficit mode at 3% of GDP, not seen in last decade or so. The one good solace about crude is that it more looks like supply disruption thanks to sanctions on Russia, and crude longer term continues to remain in backwardation. That means cash or spot crude prices are far higher than medium to long-term crude prices. One factor which we have to keep in mind that inflation adjusted crude prices haven't moved as much, and maybe there is room for crude prices to go higher. Will current crude prices push companies to make investments and increase production? Or will current crude prices not push companies to increase production? That's the million-dollar question. We believe, at least in the near term, crude prices are likely to remain higher or elevated. From an equity point of view, we have seen almost similar performance between large cap, mid cap, and small cap over a 10-year period. If you look at performance on a 1-year basis, small and mid caps have outperformed large cap by a significant margin. In calendar year 2022, year to date, first 3 months, the outperformance have been in metals and energy stocks, whereas corrections have been more in technology, real estate, media, pharma, and FMCG kind of stocks. Small caps have fallen almost 4 times more compared to large cap, and mid caps have fallen almost double that compared to large cap. Most of you will remember that for some time this year we have been talking about marginal underweight to mid and small cap and marginal overweight to large cap. This correction in market is driven by FPI outflows. They have taken $20 billion in recent times, far more than what they had taken out in 2008 subprime crisis. Against FPI selling, the saving grace has been retail buying. Retail HNI and domestic institutional investors like us have been consistent buyers in the market and matching FPI selling. If we look at period March 20 to April 20, about 69,000 crore selling by FPIs had made correction in Nifty from top to bottom of about 33%. Between October to March, almost 1,49,000 crore worth of FPI selling has occurred, and markets has only corrected by about 14%. This is all possible thanks to the huge retail investors buying. And this was acknowledged by none other than Honorable Finance Minister in Lok Sabha. FIIs and FPIs may come and go, but today Indian investors have proven even if they come and go, any shock that may come is taken care of the shock absorbing capacity of Indian retail investors. This is one of the most positive acknowledgement for the efforts put up by mutual fund distributors in bringing retail investors into our market. Courtesy retail investors' participation, volatility has remained at reasonable levels and not spiked like in March, April 20. We believe FPI flows will start moderating as their 6 months FII flow as a percentage of FII stock has reached almost similar high level as witnessed during 2007-2008. At this point of time, we believe FII flows should start subsiding. Their redemption pressure should start easing off. You can clearly see the same thing where FPI flows from 2020 has slowly and gradually turned negative, whereas domestic investors have gradually kept on increasing their stake. There is reason to be positive about foreign portfolio flows as our foreign direct investment flows have continued to remain supportive. You could see 24-month trailing FDI has continued to increase over last many years, whereas FPI flows in recent times have turned negative. If we look at performance of Indian market over its peers in Brazil, Russia, India, Brazil, Russia, China, South Africa, we have significantly outperformed other markets. From the peak of 2008 to year-end March 22, India is up about 44%, China is down 16%, Russia is down about 59%, and South Africa is up about 12%. Only Brazilian stock market has done better than India at 58%. Valuation-wise, we continue to remain neutral on market. Momentum from negative has turned positive, but it will be linked to what happens in Russia and Ukraine situation. If sentiment, Russia-Ukraine solution seems to be emerging, sentiments will become positive. If Russia-Ukraine situation seems to getting worse, momentum will turn negative. If we look at market cap to GDP ratio against our historical average of 76% at 115%, we look on the higher side. But against global average of 135%, 115 looks reasonable. On a price to earning basis, against historical average of about 18 times, we are currently trading at marginal premium of about 10%. Against price to book historical average of 2.7x, we are at marginal premium of about 15% or 20% at 3.2 times. We are little bit above our historical average, but not by an excessive margin. And hence we are giving neutral weight equity allocation call. The real issue is what happens to the earnings. Market today is expecting 881 rupees earning for Nifty 50 stock for FY23. That will result into about 23% earnings growth. At that EPS, market today is trading at about 20 times. It's neither expensive nor cheap. It is little above its historical averages, and hence we continue to maintain our neutral weight equity allocation call. Our call continues to remain same as last month. Marginal overweight large cap, marginal underweight small and mid cap, with equal weight allocation to equities. The first concern for equity market continues to remain geopolitical risk. Ukraine, Russia is at center stage, but China, Taiwan, India, China, Houthi, Middle East cannot be ignored. The immediate challenge for market is rising inflation thanks to rising commodity prices, which is pushing central banks to raise interest rates and also take away liquidity. All this have direct impact not only on the earning per share or profit of the company, but also the valuation. This has dual impact. EPS and profit comes down, valuation comes down, and hence stock prices come down, double of that. There was also WhatsApp getting circulated that Russian decision to shoot for gold could move global energy trade away from the dollar. This could also have impact, as we mentioned earlier, about dollar being the reserve currency of the world. We'll have to see how things evolve over a period of time. Finally, the most important worry for Indian companies and market will be impact of rising crude on margins. In sectors like chemical, if crude prices go up, raw material prices go up, and you end up taking a hit on the margin. Airlines also will get impacted by rising crude prices unless until they are able to pass on the price hikes or the cost to customers. There are sectors across the board which will suffer because of rising crude prices, from automobile to commodities. At this point of time, which are the funds which one should look at from an investment point of view? Well, majority of our funds continue to generate alpha for our investors. There are funds like small cap and emerging equity and infrastructure and economic reform funds, where alpha either is in double digit or mid single digit. There are other funds where alpha is in low single digit, but many of our equity funds continue to deliver value to investors. Even in hybrid category, whether it's equity hybrid scheme, balance advantage fund, or multi-asset allocator fund, majority of our fund continues to deliver alpha to our investors. Even in SIP, when you look at performance, the numbers are fairly impressive. On a 7-year basis, across all our equity funds, we have delivered double-digit SIP return. On a 5-year basis, on a 3-year basis, we have delivered double-digit SIP return to investors. And more importantly, they have come with a positive value added or alpha over the benchmark indices bearing flexi-cap fund. The same value addition is visible in our hybrid portfolio and our tech-saver fund. Let me take you to one interesting data about our balance advantage fund. Our average equity allocation in balance advantage fund since inception is 42%. But whenever Nifty rises, we give you 58% participation, even though our allocation is about 42%. And whenever Nifty falls, we only give you 34% participation, even though our allocation to equity on an average is 42%. What it means in a rising market, our equity allocation runs like rabbit. In a falling market, our equity allocation moves like tortoise. And that's how you get higher participation on upside and lower participation on downside. Our upside to downside ratio at 1.67 times continues to remain one of the best in the industry, in the peer group. For every 1% move on the way down, you get 1.67% participation on the way up. Coming to systematic investment plan, which should be recommended to investors. Well, very super conservative old retirees, we believe they should look at SIP in Kotak Debt Hybrid Fund, Kotak Equity Savings Fund, Kotak Balance Advantage Fund, or Kotak Equity Hybrid Fund. Essentially, their SIP allocations will be more towards fixed income kind of portfolio in Kotak Debt Hybrid Scheme or Kotak Equity Savings Fund or Kotak Balance Advantage Fund or Kotak Equity Hybrid Scheme. For conservative investors, they can move from Kotak Equity Savings, Kotak Balance Advantage Fund, Kotak Equity Hybrid Scheme, Kotak Blue Chip Fund, or Kotak Flexi Cap Fund. Same way, we have given preferences across average investors, aggressive investors, and super aggressive investors. This kind of portfolio maintained on a regular basis for long term should be able to deliver financial freedom to the investors. The next question apart from equity is, should we invest in gold? Now, we have been bullish gold for some time. In December 2020, it worked out with better return than fixed income. In 2021, it was disaster with negative return. In the first 3 months of this year, gold returns have been better than the fixed income. We still continue to believe that at this point of time, one needs to remain overweight gold with a 3 to 5 year horizon. Gold is considered safe haven, and it has gone up during crisis time, during war time. We also believe, like Russia, China will like to shift part of its reserves into gold. This is Russia's gold allocation vis-a-vis their allocation in US dollar securities. There was a sharp drop in 2017-18. Today, the world has recognized the value of gold. It can't be frozen. It can be sold despite sanctions. We believe China eventually will push part of its massive 3 trillion plus reserves into gold, and this will keep gold prices high. On the crypto side, we continue to say that whatever capital you are happy to lose, whatever capital you can afford to lose, that should be your allocation towards crypto, as it is a difficult asset class. Safekeeping of crypto continues to remain big challenge. Very recently, we heard how hackers took away more than $600 million from a blockchain platform. Coming to the fixed income, liquidity in banking system has become like iceberg. What is visible is a 10% of the total size, and hidden is about 90% of the total size. The overall liquidity in system continues to remain about 7,82,000 crore, but a lot of it is frozen as RBI has taken away that liquidity through VRRR auctions, and the daily liquidity available to banking system continues to remain at about 1,50,000 crore. As this liquidity tightening started, or daily liquidity started moving towards VRRR, interest rates have also started moving up. The government in FY23 budget announced borrowing program of more than 11 lakh crore on a net basis. On a gross basis, that was roughly about 14 lakh crore. And this year, in the first half, government has mentioned that they will borrow 8,45,000 crore, which is 59% of 14 lakh crore borrowing announced at the time of the budget. This has resulted into issuance sizes increasing in a significant manner. Earlier, monthly issuances was about 35,000 crore. Today, monthly issuances have increased by about 3 times to 1,15,000 crore. The inflation on a core basis have become flatter, but because of rising crude and food grain prices, the headline inflation has started moving up. Fortunately, bearing this period where inflation was above RBI's target level of 6%, by and large, inflation has remained well within RBI's target range. The yield curve continues to become flatter at the long end and steeper at the short end. We believe this gap of between 3 to 7 year looks like better position from potential policy rate moves. In state development loans, you continue to get 30 to 35 basis point extra over government securities. 10-year yield was going at 6.84%. Today it is 6.95%. But similar tenure state development loan was giving you 7.22% return, a gap of about 38 basis point. We believe markets today are discounting a lot of RBI actions. The spread between 10-year government securities and overnight rate is about 162 basis points since 2004. Currently, that is double that at 320 basis points. Our 10-year government securities used to trade at 4.5% over US since 2004. Current spread is also at 4.5%. The yield curve has started inverting in US, where a 30-year paper is yielding almost similar to 2-year and 5-year paper. Today, our real interest rates are far better compared to any other global economy. If we look at the spread of India minus US real interest rate, it is at the highest level in our history. The corporate balance sheet has also started improving, and the credit ratio, that is number of companies whose credit rating gets upgraded to number of companies whose credit rating gets downgraded, has almost jumped 6 times from 0.54 to 2.96 in recent time. The spread in corporate bond has tightened for AA papers. They have remained flat for A-rated papers, but they have continued to widen for BBB rated papers. We believe today bonds rated at A, BBB, AA minus looks attractive compared to AAA rated papers. Our debt outlook continues to remain data dependent. We believe RBI will first reduce reverse repo and repo rate corridor, maybe as early as this credit policy. They will shift from accommodative to neutral stance, and then they will start raising interest rates. We believe market has discounted many of the RBI policy actions, and which is why it is trading at a higher level than historical spreads. In this kind of scenario, one should match their investment horizon with the fund duration. In the short term, we will recommend money market fund, savings fund, and low duration fund for investors. In low duration fund, maturity is little higher than money market and savings fund, but then yield also is higher. On a medium term basis, one can look to invest in corporate bond fund, floating rate fund, short term bond fund, and banking and PSU debt fund. Over a longer term, one can look to invest in dynamic bond fund or bond fund. Our dynamic bond fund continues to deliver value over benchmark index, even in a tough market. And one can see there is a consistent performance between that. There's a consistent performance for Kotak Dynamic Bond Fund over benchmark indices. For those debt investors who are worried about lower return in debt funds, they should look at investment in hybrid schemes. Our Kotak debt hybrid schemes have delivered double-digit return over last 1, 3, 5, 7 years, and also generated alpha or value add for the investors. Same thing is true for Kotak equity savings scheme. Double-digit performance over last 1, 3, 5, 7 years. Positive alpha to the investors. Same thing is true for Kotak equity hybrid scheme. Double-digit return and low to mid-single-digit alpha generation. Our Kotak multi-asset allocator fund also shares same upside downside characteristics with balance advantage fund. Our equity allocation has been about 48%, but on the way up we participate 66%. On the way down we participate only 25%. Our upside to downside ratio is 2.58, one of the highest in the industry. With 48% average equity allocation, on way up, I delivered 66% participation. And on way down, I allow only 25.6% participation. Effectively, on the way up, our fund runs like a sports car. And on the way down, it runs like an old taxi. For debt investors, they can look to invest in a cheap market like March, April 20 in blue chip fund, which is large cap oriented fund. In a neutral market like 2021, they can come to Kotak Equity Hybrid Scheme, which is 65 to 80% in equity. And in an expensive market, they can move towards Kotak Debt Hybrid Scheme. If they don't want to do this kind of change, they can just invest in Kotak multi-asset allocator fund. It is fill it, shut it, forget it kind of performance.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.